today, our kind of topic is going to be the 2026, this new year capital raise playbook for apartment syndicators. So we're going to kind of go through a couple of different things here, as you can see on your screen there, how to build investor demand and soft commitments before a deal is even live. Your 2025 investor funnel, updating it for 2026 for bringing in new investor leads throughout the beginning of this year. What investors need to know and hear about with risk, debt, and any returns. And of course, some post-close IR or investor relations pieces that can help turn your LPs or your passive investors into repeat investors. And of course, eventually, the ultimate thing we're looking for, which allows us to really know how successful we're doing, is those referrals. So we're going to go through each one of these things here as well. It says, can you change your screen? Are you guys seeing the screen itself, or is it what exactly are you seeing here on there? It should be the website. Do you guys see that right now for the playbook, the webinar page? Okay, all right, good. So that's what we're going through right now, and the webinar sign-up page is what we're going to go through today. Is each one of those different bullets. So we're going to kind of go back and forth on a couple of these things as we're going through the webinar today. I'm planning on spending about probably 20 to 30 minutes or so going through some of this content, and then I'll open it up for some questions and answers. If you have questions, I know you've been typing into the chat box right now, but I want you to type your questions into the Q&A box, and that way I can make sure that I get through all of the questions that you have as much as I can between now and the bottom of the hour here. So make sure you take advantage of that and you utilize that Q&A box. So good. We have a few other people that have joined us here, which is good to see. We have Paul there from Boston, Massachusetts. Got TK there from right here in my neck of the woods in Columbia, South Carolina. So good to have everyone there that has joined us on the webinar today. So before we get started here, one of the things that I'd like to do is just give you a quick introduction of myself and kind of our group. So the passiveinvesting.com is the group that is behind the Multifamily Investor Nation. And I'm going to see if I can, all these pop-ups on my screen here, it's kind of hard to see everything. One of the things I did at the latter part of last year is I converted a lot of my computers over to Mac products. So I never would have thought I'd be a Mac person, but I'm turning over to the Mac products. And so a lot of these things are these new features that I'm trying to do when I do different webinars and stuff are a little bit new for me to figure out and learn. But on your screen right now, you'll see our landing page here. This is the landing page for our passiveinvesting.com. I'm actually one of the managing partners here at passiveinvesting.com. You can see myself there on the screen alongside our other managing partner with the group, Danny Randazzo. And then you can see the rest of our team here. We have Kelly there with our managing partner with Rehab Wallet, which is our debt fund. And then, of course, Cameron Broom there with our managing partner for our car wash division. And then, of course, you can see the rest of our team that we have built that have been able to kind of assimilate, if you will, to have a great core private equity real estate company that's behind us and a good team behind us as well. So feel free to go to passiveinvesting.com and click that Meet the Team page to learn more about us and our group. If you're interested in some of our current offerings that we have, you'll see that under this current offerings tab. We have a couple of debt offerings here. We have 3 kind of notes, if you will, and then, of course, our real estate debt fund there as well. So feel free to do that. Those returns are anywhere between 6% on the low end, upwards to usually 12 to 14%, somewhere around there, depending on which note that you get into. So I'm going to go into each one of those different offerings. You can feel free to do that and kind of pick through it. But one of the things I want to make sure we get through today is this capital raise playbook for apartment syndicators. So I'm going to go ahead and close my chat box here so I can make sure my Q&A box is up in case any questions come up while I'm going through this. Feel free to type them in there and I will go through them as we are going through the material here. So how to build investor demand and soft commitments before a deal is live. So one of the things that you always have to make sure that you're doing is, whether you have a deal or not, is you have to make sure that you are educating your investors, right? And even your investors that have never invested, these potential investors, you have to make sure that you have an educational process in place to make sure that you are continually educating those investors. And and I did see something just popped up on the chat box. So make sure you type all of your questions into the Q&A box. That way, as I'm going throughout, I can make sure that we answer those questions. So find that Q&A box. It might be hidden in a little three dots somewhere. It says Q&A. That's kind of where mine gets hidden sometimes. But make sure you type all your questions and answers in there as you're going throughout. So um, building the investor demand and making sure you can get these soft commits is very important before you even have a deal that is ready for people to invest in. And as you're sitting down here in January 2026 and you're setting your goals, you're setting your specific targets, if you will, for 2026, one of the things that I always stress is making sure that you set goals that you believe are just outside of what you believe internally are attainable. I actually every morning we sit down with our family. We have four children. I'm married and have four children. It ranges from I have a 15-year-old all the way down to an 8-year-old. Actually, almost 8-year-old. She'll be turning 8 later this month, and we basically sit down every morning and do our devotions, our Bible devotions, read through the Bible. We have a memory verse each week, and one of the things that was the focus of this week has been goals and kind of setting those goals and kind of figuring out what's the best way to set goals and making sure they're specific and measurable. One of the things in what they call the SMART goal system is to make sure that the goals are attainable. That's one area that I do not agree with. I like to make sure that we set goals that we feel like are just outside of our ability to attain them, because it allows you to be able to answer or ask questions that you have to answer, which allows you to actually reach certain heights that are more than what you think you can do. So, give you a quick example. If you sit down and you go, I want to raise my first, 500,000 this year. Well, that might be something that you think you can do, right? Like I think that over the next 12 months, I can raise $500,000 in some form of real estate syndication investment of some sort, right? No matter what that looks like, you think you can do that. Well, that's great, right? But what if you sat back and you said, I want to raise my first $5 million over the next 12 months? I can almost guarantee you that if you set a goal that is $5 million instead of $500,000, that you're going to easily reach the $500,000 goal, and you may actually even surprise yourself because you have to start doing things differently to reach 5 million versus 500,000. So when you set that $5 million goal, maybe you have to ask yourself, okay, well, I was originally only planning on going for the $500,000 goal, going to say maybe one conference a quarter to be able to get myself out there, maybe, talk to some people and, try to like ruffle the feathers, if you will, and try to get people to know that I'm there and I exist. Well, if you say you want to raise $5 million, well, guess what? Now you've got to not only go to once a quarter, you got to go to once a month, probably sometimes twice a month. You might have to go around to some sister cities around you to be able to get your name out there and your name recognition. And you may even need to start calling some of these organizers or some of these events to actually start speaking on stages or being on a panel or something like that to really be able to get your awareness out there. Or shoot, maybe you want to start something like the Multifamily Investor Nation and start your own podcast, start your own, write your own book or start your own like authority platform of some sort to really be able to expand your abilities and your network to be able to raise more capital, right? And so, well, let's kind of fast forward to end of 2026 in December, and you're kind of retrospectively looking at the year, and you're thinking, man, if I would have set that goal of 500,000, I would not be where I am today. And maybe you didn't reach that $5 million goal. Maybe you only raised 2 million, right? Or maybe you only raised 3.5 or 4.5, or maybe you surprised yourself and you raised $10 million, right? Well, that's a better goal to set for yourself because you start to stretch yourself, and that's really when you start to grow, is when you start to stretch yourself outside of your current abilities that you currently have. It works in not just capital raise business, it works in other areas in life, whether it be trying to lose weight or trying to make new friends, or maybe trying to find a new church, another body of friends, or whatever it may be. So making sure that you set those goals that are just outside of where you feel like that they are attainable, so that you can start to ask questions and have to answer questions that allows you to ensure that you're going to reach your easily attainable goal, but maybe even stretch even further, so you can really grow your business farther than where you are today. So these two things, this investor funnel here, you can see here on the screen, the investor funnel here, as well as the building investor demand and soft commitments, both of those kind of go hand in hand, if you will. Okay. Some of you in years past have heard me talk about the know, like, and trust kind of triangle, if you will. Well, the in order to get people to invest with you, they have to know, like, and trust you. It also goes in line with getting repeat investors and also those referrals. So let me actually see if I can. It's been a while since I've actually done a whiteboard on here. Let me see if I can find the whiteboard panel here. I think I just go to share again. So on this whiteboard, this is let's see, don't show again. Let's see here. All right. So what you want to do is I want you to go ahead and get a piece of paper out and do this with me. Okay. That way you can kind of see what this looks like. So I want you to write a big triangle on your screen. And I'm using this with my mouse trackpad. So forgive me with my artistic abilities. I'm not really that good of an artist anyway, but I want you to write a triangle on your piece of paper like this. Okay. And on your triangle, inside of your triangle, I want you to write the words investor triad. So I'm just going to write INV because I'm writing it with my I'll just do investor. Try to do this. Forgive my artistic ability here with trying to write with my trackpad on this new MacBook Pro, but this is going to be called the investor triad. And no, the investor triad's not a gang, but it does look kind of like that, doesn't it? All right, so the investor triad, right? And on the top of this, I want you to write the word no. Okay. Again, I'm writing this with my trackpad, so I'm not doing the best job here. Say no, like, and then trust. Okay. There we go. And once you have this written out, I want you to kind of follow along as I go through this process with you, which will kind of help you kind of understand how you can reach the repeat investors, but also getting them set up for your next deal as you have it go as you see it go live here. Okay. All right. So, first off, in order for people to want to invest with you, they have to get to know you, right? So, whenever you create, one of the best ways to do that is to be able to create some form of content. Whether it be going on Bigger Pockets and commenting on the different forum posts, so to share the knowledge that you have with other people, and in your signature, you can have a link back to your website or to join your group that you have put together of some sort, right? And so getting people to know you, that's actually, once they get to know you, they kind of fall down here where they might actually start to like you. And one thing you have to understand is that you can't get everyone to like you. So most people, within their first 30 seconds to a minute of meeting you, they're going to immediately make an opinion as to whether or not they like you or not. Right? They're not necessarily going to say whether or not they trust you, but they're going to say, "Yeah, I like being around this person," or maybe "I don't like being around this person." But they can't ever get to know you unless you are they can't ever get to the point of liking you unless they know you, right? So of these three things, the most important thing is to get people to know you. Yes, getting them to like you and trust you is important, but if they never get to know you, they never have an opportunity to make an opinion as to whether or not they like or will eventually trust you. So the content that you create, whether it be articles that you're writing, books that you have written, or if you're a guest on a podcast or a podcast that you're starting, or even going to various events and making yourself known at these various events is very important as well. So this know, like, and trust triad is very important for this investor to be able to attract investors. Now, once they've seen several different pieces of your content, or sometimes people meet you for the first time and they immediately know that they like you, right? Well, that consistency of content over and over and over and over again gets them to the point of actually eventually being able to trust you. And when they actually trust you, guess what happens? Something, very special happens here. Once they know you and they like you and they've seen enough from you and they start to trust you, that's when you have that next deal, that next offering that you've put together, and they're willing to put their hard-earned money with you, right? Now, you might think that this is where it stops, right? Like once they invest with you, it's where it stops. Matter of fact, that's actually where it really begins is when they start to trust you enough to wire you, say 25, 50, 100, or shoot, even a couple $1 million to be able to invest with whatever project that you've put together, right? And so uh that's when it actually starts. And once you've proven yourself to that person that they trust you and that they now trust you enough that it actually their trust goes back to know. And you might go, wait a minute, how can I go from trusting somebody trusting me to them knowing me again? That's what we call referrals. So you can write off to the side here. Let's see if I can write it like this sideways. I don't know if I actually can, but this is really where the referrals come in. When somebody knows you, they like you enough to trust you to put money with you, and you've proven yourself to them, that's when the coveted referrals start coming in, and they get more people to know you, and they go through that very same cycle. And what's very interesting about if you study this enough, one of the things that's very interesting is that the referrals, they actually skip the phase of this liking phase. They typically go straight from knowing you, and because it came from a trusted referral source, they go straight into to trusting you to the point that they will start to invest with you without even getting to know you enough to like you and then eventually trust you. There's an inherent amount of trust when something that they know, like, and trust is trusting enough in you that they start to refer you they start to refer business to you or they refer you to somebody else. It's kind of like in a restaurant, right? If you go to a restaurant for the first time and you want to make sure that they are good referrals, you got to make sure that that first visit is very, very, very solid and very important. And if somebody recommends a restaurant to you, most of the time you're not going to pull up the reviews online and say, hey, how are the reviews? Right? They're going to go straight to just say, hey, well, if this person enjoyed this place, I don't really care what the reviews say. I trust them because this person trusts them, and I'm going to go visit that restaurant, right? And they're going to go visit that food. Now, that's a very, very, very kind of of a kind of complicated process, but it really doesn't have to be that complicated. It really can be very, very a very simple process, but you have to make sure that you're putting things in place in order for that to happen. So back here on the webinar sign up page, hopefully that was helpful to you to kind of see the psychology, if you will, behind making sure that you can build investor demand and make sure that when you have that next deal that you want to present to your group of investors, that they have the ability to have those soft commits. When you have a funnel in place where you uh, are bringing in leads, new investor leads, and you're nurturing them. That nurturing phase is when you're providing content to them. No, you should never try to build an investor lead group, investor leads that say maybe they go to your website and they say they want to be on your list for investors. They should never just only hear from you when you have a deal. They should be hearing from you on a regular basis around content that can help keep them engaged, that will allow them to know who you are when you actually have a deal. Well, what we've been seeing over the last couple of years is that not a lot of deals have been presented to investors. And so there's a lot of this pent up demand out there, but a lot of people have forgotten whose list they're on because they have not continued to stay in contact with them and in touch with them. Now, several syndication groups have gone under and have gone out of business, and so there has not been that communication, and there will never be another deal from some of those groups, right? But for those that have been able to navigate these waters over the last few years, they've been very challenging and have been able to continue to educate their investors. And they're going to be set up for success as we move here into 2026 as the market starts to shift. And so those that have been continuing to generate leads, have continued to nurture those investors, will actually be very successful in trying to bring in new soft commitments and be able to get in new wires from investors and go through that entire cycle of that know like and trust cycle, if you will, for bringing in these new investors. Now, I kind of skipped around just a little bit. I kind of covered in these bullet points. I covered number one, I covered number two, and then I also covered number three. We also touched a little bit on this and so much more with some of the goal setting things from the very beginning. But I wanted, before I open up for some questions and answers, and if you have some questions about some of the stuff I've already gone over, feel free to type them into that chat box, and I'll go through some of those questions and answers here in the next couple of minutes when I wrap up the content piece of the webinar today. But this last piece is what investors need to know now about risk, debt, and returns. So in years past, there have been expectations set from investors around really high returns, right? Because we in the past I'd probably say it's been in close to 3 years ago now, where returns were 20% plus, right? Um, where you would put out a deal and you'd put out these really high return, which at the time were really realistic returns. One of the things that we started doing as a group was we started pivoting to not really trying to attract investors by trying to tout really high returns. Our typical target range for return levels for our private equity investments for these real estate syndications is kind of 11 to 13%, depending on what they are. Now, when we do our underwriting, do we want to underwrite for a higher return level? Yes. Our typical return levels will be usually between 16 to 18% when we underwrite a project. But when we present it to investors, we would rather present lower expected returns with the hopes of being able to outperform those returns, right? So being able to pitch a lower return so we can outperform our expectations or our projections for investors, right? And so as we start to acquire new projects in 2026, which our goal at passiveinvesting.com is to start acquiring more deals here in the apartment syndication space here in 2026. So if you're an investor and you're interested in investing in apartment syndication, or you want to stay in touch with what we do, you can go to passiveinvesting.com and you can sign up as one of our passive investors, and you'll get a phone call and an email from someone from our investor relations team to get you onboarded, so you can start seeing some of the content and the education that we are putting out, and you can stay in contact with us. But I believe right now, even which has been the kind of the sentiment for the last several years, that debt is lower risk, so there is usually typically a lower return for debt. But where the returns have really has been in the debt side of things, which is right now. As we've wrapped up 2025 and we're kind of wrapping up here or going into 2026, going to be kind of closing out some of our note offerings. Debt has been a very attractive thing for a lot of passive investors, and so we currently right now have several debt offerings, and the risk versus reward has really been in the debt space, if you will. And so you've probably seen a lot of different groups come out with these different debt or note offerings, and it's because the risk versus the return profile has really heavily been weighted in the debt space because of where you are in the capital stack from a debt perspective versus an equity position. The one thing that you don't really get at all, or you don't get, is depreciation. And so being able to look at the ability to utilize depreciation can help these equity offerings, and being able to buy assets here in 2026 that are below what they were sold for over the last several years can also be very beneficial when you're trying to attract investors from that perspective as well. And so being able to, in your content and your education, being able to talk about the risks versus the rewards of debt versus equity investments is very, very important, versus with it, which also includes your depreciation benefits versus non-depreciation benefits from an equity versus a debt perspective. And of course, having investors understand the risk, the return profile, if you will, of debt versus equity. and making sure that there is a, excuse me for that, and making sure that there is a good kind of a balanced approach in your portfolio of these debt offerings, as well as these equity offerings as well. I, I was actually talking to a institutional, um, when I say institutional, it's an institutional equity market, meaning not necessarily real estate, if you will, but in the stock market investment advisor. And he's a very high level investment advisor for one of the top investment firms in the country, and even just around the world. It's one of the top. I'd probably say they're in the top five of asset holdings. And his group himself, they manage, I think, probably 6 to 7 billion in assets himself. And I was actually talking to him through one of my, not through, but with one of my other good friends that was looking at, needing somebody to help them from an investment advisement perspective from a large portfolio he has. And he asked me, he said, I know Dan's on the call and he likes these debt and offering and kind of passive investments, but what would you recommend in a portfolio if you were putting it together right now of debt or these passive offerings, versus equity stock market of investments? And he said, right now, with the way the stock market is, with it being so high valuations, the valuations being so high in the stock market right now, he said, it may continue to go up in 2026. He said, we don't really know. We don't have that crystal ball. But if I was putting together a portfolio today, I would have 35 to 45% of my portfolio in the equities and the stock market side of things, and about 55 to 60%, maybe even 65% inside of these kind of passive investments that are outside of the stock market. And I thought that was very telling because, I was on the call and my buddy was the one that asked the question. And he's like, I know Dan's on the call and he might not like your answer. And it wasn't premeditated at all. Like I didn't prompt anything. I just kept my mouth shut because I was curious myself as to kind of what he would recommend. And he said, because of where we are in the market, that's what he would recommend. I thought it was very interesting. Um, so being able to kind of share that with investors of what these kind of institutional level investment advisors are seeing right now in the market, and even taking some of their articles and being able to summarize that and kind of articulating that into an article of yourself that would allow people to make some good decisions on how to balance their portfolio out. Because what I always hate seeing is when the stock market gets really high and high valuated, very high valuations right now in the market, and all of a sudden we have this recession or this market crisis, and they drop by 30, 40, 50, 60% all of a sudden, like in the matter of days or weeks. It can be very unnerving for a lot of people that have worked their entire life and have these life savings that just get wiped out, and they freak out and they sell at the bottom, right? Well, it'd be better for you to sell at the top, right? And then wait for that market correction, then buy it at the bottom, right? So, and I think that's one of the reasons why he made that recommendation of that kind of split, if you will, between debt and equity offerings. All right, so I'm going to pause here for just a moment. I know we have a few more minutes left here, probably another 5 to 7 minutes. So if you have some questions for me, and if you want to find that Q&A box, go ahead and type them into that Q&A box. Um, we can certainly answer any questions that you may have before that. So, one of the questions here is, how do you get investors to trust you before they invest? That's what I was just talking about on the webinar, and that know, like, and trust cycle. In order to get somebody to trust you, they have to know you first, right? And once they get to know you, they're going to make an opinion as to whether or not they like you or not. If they don't like you, they're never going to get to the point of trusting you to invest with you. Okay. Don't worry about those people. You don't need to worry about those people. Those are like an uphill battle trying to convince them to actually like you to the point of trusting you. But the way you get them to trust you enough to invest with you is they have to continue to hear from you and see content from you, and you nurture those leads. So doing something like this, like what I'm doing right now, some of you on here, it's your first time ever hearing from me before, right? You might have heard of our Multifamily Investor Nation group. Maybe you've watched a few of our webinars, but you've never actually heard from me, or maybe you've never heard from one of our other people in our group. We use these as a way to be able to get people to hear from us and us to nurture some of those leads of like, hey, here is who we are. Here is how we operate. Matter of fact, if you get a copy of our book, as you can see that on the top of your screen here, you get a copy of our book, we outlined in this book exactly how we do what we do, why we do what we do, right? And this is both for active and passive investors. Of course, one of the reasons why we put that together is because a lot of people try to hold back giving information to people about what they do, what their secret sauce is. There is nothing secretive about what we do. It is a very, it's not very, there are some people that, put out books that talk about how easy apartment syndication is. I don't think apartment syndication is very easy at all. It is actually not very hard. I mean, it's not, what makes it challenging is that there's a lot of moving pieces and parts to it, and you have to make sure that you put things into place, right? But you have to make sure that whenever you have investors, that they hear from you over and over and over again, and that's how you build trust to the point where they actually want to invest with you down the road, right? So if all you do is go to one conference, you put them on an email list, and they never hear from you until you have another deal, you will fail. You will not have enough investors to invest in your next deal. So that's going to be the challenge for you when it comes to getting people to trust you before they invest. I have Keone here. Good to see you. Aloha from Hawaii. I'm out over there, way out in Maui. I do remember our lunch that we had out there. I'll actually be coming back in spring break this year. So in the end of March, we'll be coming back. They're going to be staying in Oahu for most of our time, but we'll definitely be visiting a Maui on one of our days that we're going to be out there. We'll probably be out there for close to 2 weeks, I think. What we're planning on doing is being out there for 2 weeks. And I'm going to bring the whole family with us this time. So it should be a fun time. We've been planning that for probably 2 years now, since we left the last time, Keone. All right. So one last thing in here is are you switching to a debt focus versus an asset acquisition focus? And I would say no. So our focus actually switched a couple of years ago to primarily a debt focus. We will continue that debt focus, but we are and have been continuing to look at acquiring new assets. The challenge has been there has not been very good deals out there in the market. There is still this huge and massive kind of bid-ask spread between buyers and sellers. But we feel like as we move forward here into 2026, there's going to be some deals that are going to be unlocked. They're going to have some great value in them. And of course, debt has now started to stabilize a little bit more than what it has. I do also think that as Trump makes some changes with the Federal Reserve Chairman, that we're going to start seeing some relief, if you will, on the debt side of things. That's just going to unlock even more opportunities for selling assets at some great valuations, but also buying assets at some good valuations as well. And so we are actively looking to acquire assets here in 2026. And I think that that's going to be a good thing moving forward. So, all right. So thank you everyone for being here on the webinar. Let me see if we have yes, we do. We have our next webinar scheduled here. You can see it here on your screen for Tuesday, February 3rd. Matter of fact, that's a special day. That's actually my birthday. So I'll be turning 43 years old the next time we have our webinar. I won't be hosting that webinar myself, but you'll be hearing from Ed Gilmer there, our Director of Capital Markets, on selecting the right buyer. So how to execute a successful multifamily disposition, selecting the right buyer, LOI and PSA negotiations, managing the due diligence, handling contracts and vendors, closing checklists and final steps. Ed has done this many, many times for us and has a wealth of knowledge with this. And I would highly encourage you to register for that webinar and be a part of that webinar as well. So you can just go to multifamilyinvestornation.com, register for that next webinar. Thank you everyone for being here. Glad to kick off this new year here in 2026 by sharing my knowledge of how you can set yourself up for success here in the new year. So thank you for being here, and look forward to having you here on the Multifamily Investor Nation on your next webinar here coming up in February.